The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome this evening to Become a Pro course, of course, here at Forex.Academy. I am your host, Robert Blackwell. I have the pleasure to walk you through tonight's lesson. Of course, we're going to discuss technical analysis 2. So yesterday's lesson, of course, we went through a lot of technical analysis. It was quite heavy. We discussed Fibonacci retracements, many of the technical indicators, focused on price action analysis as well. Today, particularly, we'll be going in much more depth in terms of how to conclusively use all that analysis together. Okay, so it'll be very enjoyable, and please ask questions throughout. Now, of course, there is risk inherent when trading in financial markets, so please do consult the following disclaimer and just take note of the risks involved in trading, of course. And just a few pieces of housekeeping before we begin each interactive live webinar. Feel free to ask questions throughout, guys. You have the chat box there located on the right hand side of your screen. So throughout, as we go through the presentation, if you'd like to ask me questions, I'll be able to see them and of course be able to correspond with you in answering your questions almost immediately. This live webinar is being recorded and will be placed into your members area once we have concluded. And again, if you could just give us a grace period of 1 hour to process the video, we'll have it fully revisable in your members area for revision purposes. And of course, if you'd like to hold off in some fashion for more complex questions towards the end of the webinar, we like to host a Q&A session towards each live webinar to deal with any questions that we may have throughout. Okay, so let's just recap where exactly we are at this moment in time. We are, of course, at week 3. This week, we're very technically heavy. Of course, we went through the components of technical trading, examining the theory and practice of looking at price action, looking at structurally how we look to identify market structures with the price action analysis, and how that plays into the role of historical context. So if you're a simple support and resistance trader are looking for those long-term inflection points in the market, that is something interesting for you. Then we moved on to technical analysis 1 with a lot of technical opportunity discussion over a wide range of technical indicators, understanding, of course, they have various advantages and, of course, various disadvantages to using them. So today, more in depth in terms of the construct or the structure of conversation we're going to have around technical indication. We're going to discuss 2 technical theories in terms of theoretical technical analysis, Dow theory and Elliott wave theory. And of course, we're going to discuss technical confluence. So guys, if you are planning on becoming a completely technical trader, understanding how to use this technical analysis to your best ability, you're going to need to understand the concept of technical confluence, okay? Which is really how to look and appreciate all the technical aspects of trading and when to use specific indicators with one another to get the best trading ideas, okay? And then obviously tomorrow then we'll discuss fundamental criteria of currency trading, and again that will bring us back to a fundamental aspect of how to price assets. More particularly, we'll be looking at strength and weakness over the forex pairs. So without any further ado, let's discuss technical confluence. So this will be one of the main constructs of today's lesson. Technical confluence underpins absolutely everything about technical analysis, guys. So absolutely everything. Why? Because, well, we use technical indicators to supplement our trading decisions, to give us technical clues of future price movement. Yet sometimes we completely forget this concept and get so wrapped up in looking at one particular indicator or testing some new oscillator perhaps, that we ignore that technical analysis must be used all together to identify trading opportunities. Okay, so confluence simply means using various forms of your identification together to confluently paint a picture of price direction. Now we know and accept there is no one sign in technical analysis which will clearly make up your mind as to whether you want to be long or short a particular financial instrument. What you will find is that you will have a whole host of technical indicators to work through on a regular and disciplined basis. Okay, so a regular disciplined basis. The clearer the indication pointing to directional movement, the better idea you have to trade off your technical analysis. Now, does that make sense? It's very forthcoming, it's quite obvious. The clearer the indication pointing to the directional movement, the better idea you'll have to trade off that analysis. So if you have 3 very good uses of technical analysis, and then you get something supplementary in terms of the price action itself, rejecting an area, then you can look to trade off that quite substantially. Okay, so let's go through a technical confluence in its remit. Why is it advantageous for us? Why do we like to combine our skills together? Well, confluence is the presence of 2 or more technical elements in the same chart location. Confluence can strengthen our case for taking a trade. Different traders look at different technical signals. Okay, so why might this be of use to us? We know that, well, as a collective organization of traders, market participants across the globe, trading all these asset classes, perhaps fundamentally, perhaps technically, whether we're all using the same indicator or not is not the question. The question is, of course, that we're using all of the indicators that we know that are of use. So if that's the case, well, what happens when the different signals converge? So perhaps we have a perplexed trading atmosphere of 20 different trading indicators and signals that we can use. Yet some of the most prominent ones are converging on a price or an indication telling us there's going to be a market reversal. All of these traders are looking at the same price movement, so this creates a high probability setup. And we often talk about trading being at times a self-fulfilling prophecy. So the Fibonacci retracement indicates level of retracements. There's so many technical traders that are observing this price action around this area, that when price moves away from the area, that gives them the signal that increases price speculation in the direction. Okay, so it gives us a high probability setup, not only if we can spot 3 or 4 indicators that suit our trading decision or direction, but that there are also, be aware, there are also so many traders using the same sample data, the same price action analysis, and the same technical indicators. They're looking for the same things. So bear that in mind. That is why we like to use technical confluence. And of course, it increases our chances of success with the trade. That is high probability trading, of course. So guys, what we're going to do now is have quite an enjoyable time. We're actually going to trade hypothetically together across many different charts, and we're going to use technical confluence to suggest how we may trade this market. Okay, and inevitably some are going to be very good trades, and we can pick apart some trades that may not have worked. Okay, so what do we see in front of this chart in front of us? Okay, so I'll just talk, I'll pick out some points here and we'll discuss them together. Well, we have the US dollar, Canadian loonie, the Canadian dollar here as well. This is the daily price action, so it's fundamentally a very structured market, of course, looking at the daily price action. Okay, so what I would like to do is just to go through quite a bit of analysis here. The first thing I'll notice is, well, what do we have on screen? We have a Fibonacci retracement and we have our RSI indicator. So let's go through them one by one. The relative strength index. Okay, so what does this tell us? If we can remember back to the previous lesson, of course, we are looking for areas in the market that are indicating with the indicator that are correct. I can see all these answers coming in: overbought and oversold. Again, the technical points of inference are our 70 point here, indicating an overbought signal, and our 30 point here, indicating oversold. Okay. So what we're looking for again is the best signal where, of course, the market trades past these levels and is then looking to reverse, or of course maybe touches these levels and gives us our direct signal. Okay, so what we can see, of course, is as the market trades up, well, we have a high here, and that is, of course, well documented on our RSI. Okay, this level is overbought, but let's say we're not privy to this price, so Then as this market trades down and creates a new low here, well, we have a couple of signals here. We have the RSI effectively trading in the same manner from high to low. Okay, so we're waiting for a technical trader. We can see perhaps we want to get long, perhaps we believe in the overall trend structure to the upside. Okay, and again, as we go through, we'll discuss Elliott wave theory within this particular webinar. It discusses waves where trends move in particular direction, but of course not in a linear fashion, but in accordance to waves. So again, let's go through some of this analysis, guys. We believe in the full term structure to the upside. I'll just highlight this here again. So our choice then, when we get to new lows, is to look to see if this is a retracement. So what should we use? Well, we use a Fibonacci retracement. Okay, so that is the second indicator that we've chosen to add some confluence here. Okay, so the Fibonacci retracement indicator is there. Now, do you remember exactly how we use this? Again, any trading below, say, below our 61.8% is effectively invalid. So I'll go through this just again to reiterate and go over some revision here. The Fibonacci indicator is looking for retracements. It's a Fibonacci retracement indicator, i.e. the market has to pull back. So the best risk reward is, of course, our 61.8% retracement. Now we have other levels, our 50, our 38.2, and our 23.6. But again, if we are looking to follow the full trend structure, then the best pullback is the full pullback to our 61.8. And effectively, this is what we see. We see some very interesting price action in and around. Basically, the trend trades down with some bearish action and stops in and around our 61.8% level. Excuse me. So what we do is actually observe our RSI indicator at this particular time, right here. And you can see it almost is at our level of interest, or 30. So we don't have to get the perfect signal again. We're going to use some analysis together. So as long as we get a rough idea of the signal, of course, it may support the trade. Does it support the Fibonacci? Well, the 61.8% level is holding up. We do get some price action with this one candlestick, again, trading to the downside, but it retraces into one candlestick again. So then what we do, now that we have a good signal from our RSI indicator, again, it's at our 30 level. We have the perfect retracement level from our Fibonacci retracement. Well, what is the next thing we do, guys? Again, one of the main constructs of technical analysis, don't think of technical indication all the time. Fantastic, Mark, yeah. And I can see you're all putting in roughly the same answer here. Price action, guys, or trading the price action again. And what we do is look to define little structures again with very good price action analysis. Again, this little structure here is important because it's at our 61.8% level. That is of significance to us as a technical trader. We look at the price action, and again, we get we actually get the reversal signal with our bullish candlestick right there, trades up and closes well above our little structure here again. So, and it's almost engulfing in terms of the size of that candle in relation to the previous 5 candlesticks. So that is our buy signal. Again, that is the trade we could make. What we could look to do as a technical trader is to buy the market just above these highs. The market trades then here, and as you can see, we get the breakaway. Now, evidently, we don't get the full trade to the full retracement level. That's okay. We get the market trading up, albeit it breaks through 1, 2, and touches our 3rd retracement level. So that is a very, very good trade. So we can look to take profit in and around. Again, these are support and resistance levels based on the retracement of the Fibonacci indicator. So if we were to decide to take profit at 23.6, we could have done it several times. We could have done it just here at this high of the candlestick, and then we broke it here just once. Now the trend reversed, but evidently that is not the trend or the trade we're trying to take. We are simply taking the trade with best analysis here, and we have, again, just to supplement the trade decision, guys, RSI supports the trade at 30. The price action structure and the candlestick supports the trade, and then the 61.8 is our best retracement level from the Fibonacci indicator. Great trade to the upside. We can take profit in and around these points here. So you can see how we put that together. Again, it's great to see it in hindsight, but if you're following the education, other education here with live trading at Forex Academy, we made this trade. So evidently a fantastic trade, again, just as a result of some technical analysis. Let's move on then to trading another market. Okay, so it's going to be quite interactive here, guys. So what we have in front here is the US WTI crude oil market. What we can see first of all is we have support and resistance levels. Where are they placed and why are they placed? So, well, they're placed right at our interesting levels here at 66.32. So right here, and again 57.80. Why? Because they're the last corrective lows. Okay, they're the last corrective lows in the market. Again, we could choose to subjectively just choose these highs again across, but that would give us roughly the same signal. So we've chosen our high and low point during the swing trade, but that is not the trade that we're currently trying to observe. So we have our levels of support and resistance in place. Okay, now effectively what that means evidently is, well, if the market trades below this level here, that is going to suggest that we're not going to take the trade to the upside. Again, very simple analysis. Why might we be looking to take the trade to the upside? Again, simple directional bias, guys. Well done. Simple directional bias. The market is trading strongly to the upside. It does pull back again. We could, of course, use different indicators here, notably the Fibonacci expressed in the last slide. However, we've chosen some separate trading confluence here. Okay, then we get this candlestick right here, the price action, okay, of this candlestick telling us, well, it rejects our low. That creates a structural low and is supportive to the upside. Okay, so let's move across. We have a price channel. Okay, so as this starts to trade to the upside, we see we can have an input a price channel to the most relative price action. Okay, so of course the price channel is trading in the direction we want, that is supportive of the trend. Again, what we see here is the structural low. So we're not privy to this at this moment in time, but right here is very substantial in terms of that price action, guys. That price action tells us that this market does not want to trade lower. We have two indications that the market has rejected trading to the downside. Okay, and the market continues to trade to the upside, evidently to these highs here. So guys, where could we look to place a trade here? Okay, well, based off this analysis already, we could potentially look to trade this candlestick here. Now, this candlestick here, of course, breaks the low, so we don't trade that just yet. We don't just necessarily buy a candlestick that's trading to the downside. However, the next candlestick is our signal. It's right at our price channel. It's when it gives us the best entry, and again, the market moves up to the upside. So that's just one trade we could do. Is there any other analysis to support that? Well, we have Bollinger Bands here, guys. So Bollinger Bands, again, they're based on standard deviation from the mean. Okay, so this set of Bollinger Bands I have placed is actually what I like to use is 2 standard deviations from the mean. Okay, and that is effectively what we're doing here. The top band is expressing 2 standard deviations of the mean trading using the moving average to the upside, and adversely the bottom Bollinger Band is expressing the 2 standard deviations to the downside from the mean. However, we can use these to have a look and consult the volatility in the markets. Okay, so what we do is, well, we understand that these Bollinger Bands here are starting to contract. So what I'll use is the blue marker just to describe this. They're getting thinner as they move down. They're actually contracting and they're getting thinner. That leaves us to believe that there's less volatility in this market over the long run, as opposed to right here and right here at these points. Okay, where they're very wide. So when the market trades down in and around the very, very thin or contracted Bollinger Bands at these points, we could say, well, there's not a lot of volatility in this market. It does look like it doesn't want to trade to the downside. It does look like it's following the price channel, and of course doesn't the price action is supportive of no trending to the downside. Again, we don't need the full setup for the market to trade right down to our Bollinger Band level here to try and buy the market, we can subjectively say it's enough to use that. Again, we have enough analysis. And again, what we could use is some more indication. We have volume. Again, you can see, guys, as the volume trades with this trend, why in the first place do you want to become a directional does your directional bias want to suggest you'd like to follow bullish momentum? Apart from the trend, you can look for the volume. Now what I'd like to do is just literally score across the volume here to the downside. That's roughly our average volume here, okay? And then coincidentally, once we see this trend start to trend to the downside and then reverse, yes, there's some volatility expressed by this momentum, but then our average is almost raised above and beyond when the market starts to trend to the upside. You can see that. So effectively it tells me there's more volume, there's more interest in this market, and when the market is trading to the upside, the Bollinger Bands are contracting, they're getting thinner, so there's less volatility, but there's more volume. Well, that is a clear indication that price action wants to trade to the upside. Again, a big supportive move to trade this market with all of this intact. Okay, so let us consult, and I always like to put this in at the end. Price action is key, and again, the price action is always going to be the signal where we can use for the best time to enter the markets, and that's right here. That's one particular trade we could enter right here above this high. Again, we could look to follow the price momentum up. You could have, of course, bought the market there, considering it's close to the price channel, excuse me, but also that within this little channel here, okay, the market is actually trading above the 50% percentile of the mean standard deviation over average here as well. So that would be supportive of actually looking to buy it just at the average price. So there's a couple of trades you could really pick out. I know I have a lot of analysis on screen there, but it's really all of this combined. So we have 5 things here confluencing this trading idea for a few trades here. Again, what we have here is our Canadian Japanese yen. Okay, so a very, very interesting market, of course, with the Canadian dollar moving according to oil prices a lot of the time, and now interest rate changes. Japanese yen, of course, are a barometer for risk in the forex markets. Very interesting market on the fundamental side. Let's get into the technicalities of it. So again, we're familiar of some of the technical analysis we have here. We have, first of all, a resistance level. Okay, that is right at this point. Now, I've chosen this market because we're not sure what to do at this moment in time. And that's good because I'm not only picking some trades here. You could simply say, well, okay, we have a downtrend to the overall downtrend to the bottom here at or around 81 level. Okay, so that's our effective low. We've used a Fibonacci retracement. Of course, we're looking for bounces off the area. Okay, so effectively, that signal does not provide us with anything too conclusive. However, you can see we have some levels of significance. Again, when we get a break of that level, perhaps we would look to follow momentum. So we get a break of this level. Does the price action support it? Well, that is, of course, a reversal signal to the upside. Very strong closing above the 23.6% retracement level, telling us that, well, the market still has room to move to the upside. But let's result in more common price action. Right now, we are at this price action right here. We have something significant. Okay, so we have a reluctance to trade this market to the upside. Okay, so we see with this candlestick right here, we get a rejection, then we get some trading, but again, we don't get continuation to the downside. We don't get anything technical telling us that the market wants to show us some real significance. And that is how you can use Trading Confluence again to look for trade ideas, but to offset your own convincing trade ideas, with markets in question. So let's go through some of this analysis here. What we have effectively is a Fibonacci retracement. We have moving averages there, so we have a 100 and a 200-day moving average. Of course, the smoother blue moving averages are longer 200-day moving average. We have ATR, or volatility, okay? And of course, we're going to use the price action to look at this market. Okay, so what do we do now? What do we do at this most relative price action? Well, we know that, guys, This new price action is looking that it is all trading much below our moving average. Okay, now the moving averages are slightly complex here because they're trading in a horizontal fashion. Okay, yet the 100 moving average is looking like it's just swiftly trading, a little swifter, of course, lagging to the downside. Okay, so I'm just going to follow this indicator down. So it could give us something like that. Okay, now the 85 level is our support and resistance, and it's right at that level. So look, if this level continues to trade to the upside, then I would say the support level is broken. Now again, because we're not looking to trade the Fibonacci, we can look to actually trade it in terms of using it as a stop loss as well, picking those positions. What do I mean by that? Well, let's say you want to trade this level of support and resistance right at 85 where we have it now. So the red line across screen is our support and resistance. You could look to sell the market at the moving average price, of course, this green line that we have trending to the downside. You could, of course, then choose to use this as your stop loss, as your signal. So let's say the 50 level is significance as an indicator. You sell the market today. I'll just remove that so I can put my stop loss here. Sell the market today, and you put your stop loss in and around a level where you think comfortable that the indicator fails at 50% retracement. Again, right here, you're going to need a couple of things to fail here. You're going to see that, well, your moving averages are going to fail, both of them, if the market trades up above this price, and the blue moving average, which is just here, is going to fail. So that gives you some idea to perhaps look to short this market. Also, as this market has traded up, you've seen there's a lot of volatility trading this market to the downside as we look at the ATR within our ranges here, okay? A lot of volatility trading this market to the downside. And as it lifts off from the lows, there's still some volatility in the market. However, as it trades up, it's trading up with a lot less volatility. So there's not as much volatile price action pushing this to the upside. So what does that suggest? We can read into it what we will, but as you see, the volatility really decreases down to nominal levels here at the current price action. So we're not expecting a very volatile move to the upside, are we? So if our stop loss is around this level, we're not expecting a very strong move to the upside, perhaps in the next 2 or 3 days, to break all of these levels, to break this technical analysis, to break the moving averages or resistance level. We need something strong, and we're not seeing that here at the ATR. So effectively, the ATR there is giving us a positive signal. Now I'll just go over this analysis yet again. So I know it's, for some of us, it may take some time to sink in, guys, because we're actually using all of this technical analysis together. So the price action is so important as well. Well, we'll start from the start here. The resistance level as well seems to hold up. Why does it hold up? Well, you can see how the price action trades, okay? It is looking to reject all of these new highs. We can use the Fibonacci retracement to say, well, the long-term swing trade is to the downside. Again, we can use that as our stop loss in around above the 50% level that the signal potentially in the short-term trade has failed, okay? So we can use then our moving average to say, well, they are smooth moving averages, okay, but the closer dated moving average, or the shortened time period, the 100-day moving average, is slightly suggesting that the trend is still continuing, although it's lifted, it's still continuing to the downside, so we want to be short. And the ATR has left this market, so we're not expecting a large move in this market with volatility to rise to actually get us out of our trade, okay? This market could just drift at these levels and then trickle lower. So hypothetical again, but using all of the technical analysis to look for potential trading opportunities. And I wanted to choose this market again just because we haven't actually looked to see how this market has traded over the past recent time. This is the recent price action. Okay, now on to yet another trade. And surely but slowly, guys, you know, all of this is hopefully starting to sink in with you guys, using all of these technical indicators together and using the confluence to suggest possible opportunities. What we have now is a relative price action, okay, but we had a very strong move in the cable market recently. So we're reviewing now the daily price section of the sterling dollar market. Now let's go through some of this analysis together, and what I'll do is just go through again one on screen. So we have a resistance level. We can see that that's a red level here on top. It's indicating the resistance is sealing right at new highs. Again, it's significant because we have a long-term high in this market, but that is touched again and looks to trade to the downside yet again. So very significant, guys. We'll take that as is. Trend lines. Well, we have some very convincing trend lines. However, surely, well, the trend is to the upside. I mean, look at the trend line. So does that not conflict our trading idea of looking to trade this resistance level? Well, again, the beauty about technical analysis, guys, is that it's objective. So, of course, you could look to say, well, if this market trades up here and starts to increase that compression, we'll look to use a pending order here to look to follow a big burst of price action to the upside. But again, we have trend line number 1, and again we have trend line number 2 in here just to look to actually see how this market is reacting. Now, what trend line number 2 does, it makes the price action more relative to us because it observes the most recent price action, okay? And what we can see is that price action congests and gives us an ascending triangle. Now, as we discuss ascending triangles, the preference is to actually look for the breakout trade from the breakdown of the triangle. So if you have a descending triangle descending to the downside, you're looking for the breakout to the downside, but the triangle is there as a result of some diagonal line, of course, providing support. Then the ascending triangle is doing the opposite, of course, which we have on screen. It's compressing price action to the upside, but when that fails, the signal is not for the breakout trade, but to observe price action the other side of the market, okay? And that is what we see here on screen. What else do we have? We have a stochastic oscillator. Now, again, can we remember what the stochastic oscillator denotes to us, guys? It is not overbought, oversold signals, but very, very similar. It is, of course, a momentum oscillator. Momentum, as a rule of thumb, is moving, or is a primary factor before price movement. Indeed, guys, the stochastic oscillator is a momentum oscillator, showing us that there is some exhaustion in momentum at these levels, okay? So what we can see here, guys, is that we have a very well informed trade here. So what I'll do is just go over, and of course, before we go over the trade, we must include our friends price action. Okay, we have a double top formation and we have the price action following each candlestick to show us how to trade the market. Let's go through the trade again. So trading confluence is to use all of these technical indicators to the best of your ability. We have a resistance level. That resistance level is holding up very strongly. The candlestick at the top of that range suggests it. Actually, what it does is it creates this structure in the market where we effectively have a double top formation. So that is very, very significant in terms of market structure. Then we have our ascending triangle, and again with our trend lines, they have been broken to the downside. And again, it's not a false breakout. It trades down and then it does not ever come back. It does not ever come back. So that's a big no-no. That is, of course, supplementary to trade this to the downside. And again, look at the stoch, guys. Look at the stochastic oscillator right at these levels. It's at a high. It's breaching our 80% level. A very good signal that we can take all in to say, right at that level, guys, right at this level, it's telling us that we should sell this market, basically, that potential upside momentum is exhausting. And you can see as it trades to the downside, it just moves quite fastly. And again, this is a fast stoch indicator. You might like to use, of course, the more relative slower stochastic oscillator for yourself, but it depends on your trading style. Of course, I like to trade more relative price action. So again, you know, we have, let me just take that off. So we have everything stacking up in our favor here. What is the trade here? You know, totally objectively, not trying to read the news and understand what is happening. Why is the dollar strengthening? Why is sterling moving down? Of course, if you can do that, it's going to help your trade decision. But the technical analysis stands out like a sore thumb here, guys. So trading confidence is there. All in all, to use all the skills together, we're starting to learn more, guys, and get involved in trading these markets using these skills. You might prefer to use, certainly I have to be honest, I use maybe 10 that I prefer. There are a whole range of different indicators, but there are 10 that I used to use together. Some give me indirect signals and I just ignore those signals. Of course, others, like a trade like this, tell me exactly what I need to know on the technical basis to capture big momentum trades. Okay, that's effectively what we see here.